Well, welcome back to Financial Accounting 1. And the purpose of this little mini lecture is to review the solutions for exam number 1. And I would encourage you, when you watch this video, to have out your marked exam in front of you. And basically, the way I graded it, each multiple choice question was worth 3 points. So you take the number of multiple choice questions you got correct, multiply by 3. And then each of the problems was worth 10 points. So you'll see them listed: problem 1, 2, 3, 4. Each of them would have been a maximum of 10 points. If you got everything right, there's not much trick and scratch in the text that follows. If you made errors, I crossed out, which put X's and so forth where you had errors. So here goes. Let's start with the multiple choice first. Using the perpetual inventory system means that every increased inventory is recorded, every reduction of inventory is recorded. And it says the entry to journalize the sale of merchandise on account and the corresponding cost of goods sold. So when you sell stuff, sell the merchandise on account, you would debit accounts receivable and credit sales. And then you would also have to debit cost of goods sold and credit inventory. So the entry to journalize the sale of merchandise on account and the corresponding entry for cost of goods sold is C, credit inventory. Again, with these multiple choice questions, when they have to do with journal entries, it's a good idea to do the journal entries first. In that case, there would have been 2 of them, and then go look for your possible answer when comparing it to your journal entry. So the answer to 1 is C, a credit to inventory. Where are selling and administrative expenses found on the multiple step income statement? Well, the multiple step income statement shows sales minus cost of goods sold gives us gross profit. From that, we subtract out the selling and administrative expenses, and then we get the operating income. So where are selling and administrative expenses found on the multiple step income statement? Well, D, they would come after gross profit. Number 3, a company uses a periodic inventory, and in periodic inventory system, we don't know what's in inventory till we count it. We don't know what cost of goods sold is until the end of the period when we count the inventory. And the cost of goods sold calculation is beginning inventory, which in this case is 210, plus the purchases, which are 635, minus the inventory of 160. So the cost of goods sold is 695, and that corresponds to B. Number 4, inventory at hand at the end of the year. We take a physical inventory. We've got 63,000. However, there's stuff that we purchased for $6,000 that's free onboard shipping point. And if it means free onboard shipping point, that means we actually take title of that merchandise when it gets to the shipping point. So the total amount of inventory that should be recorded is the original 63,000 that I counted, plus this 6,000 that has reached the shipping point. So we get a total of 69,000 there. Pierce sold merchandise on account to a company, terms 210 net 30. Prepaid, and it was free onboard shipping point, which means the buyer, not the seller, the buyer has to pay the freight. So the question is that we sold the merchandise, we recorded the sale on account, we also paid the shipping. So there's actually 2 entries that we've got to do here. We've got to debit accounts receivable, Stanton Company for 20,000, credit sales, and then also we debit accounts receivable for $500 for the amount of the freight bill. So we debit accounts receivable for 500, credit cash. So answer to 5 is actually B, which is 2 entries. If revenues are correctly reported and the gross profit of a company is understated, well, if you understate gross profit, what is the effect on owner's equity? Well, remember the multiple step income statement, understate gross profit. Therefore, you just do a couple more subtractions there. If you understate gross profit, you're also going to understate net income, which means you're going to understate owner's equity. So the answer there is A, as in apple. This next one has to do with the lower cost to market rule. So a lower cost to market rule, we take the quantity and we have to multiply to get the actual value of the inventory. We take the lower of the cost of the market. So product C, 300 units, and the market price is actually lower. So I take 300 units at 5. And product D, I got 420, and the cost price is less than market. So I take that. Add those together, I get 6,450 at the C. Number 8, cost flow is most likely to be in reverse order, which costs were incurred when using the last in, first out. Last in, first out. What that means is basically you charge off the cost of goods sold the most recent purchases of inventory. So that is by definition last in, first out. The last stuff that came in is the first stuff that we get rid of in terms of the cost flow. So the answer there is B. Number 9, days sales and inventory. Well, days sales and time and inventory is the time it takes to acquire, sell, and replace inventory. So the answer there is A. That's the definition of sales and inventory. Number 10, inventory is made up of the oldest purchases when you use LIFO. It's made up of the most recent purchases when you use FIFO. So LIFO, in terms of rising prices, will give you the lowest value of the beginning of the ending inventory because you're valuing it at the oldest possible cost. So inventory is made up of the oldest possible purchases. The answer there would be B as in boy. 11, what are the processes and procedures a company uses to safeguard its assets, process information correctly, ensure compliance with rules? Well, that's the definition of internal control. So the answer there is C. The amount of outstanding checks is recorded on the bank reconciliation. That would be a deduction for the balance per the bank statement, which is C. Outstanding checks, the outstanding checks means they've already recorded them in the T account cash, but they haven't yet hit the bank statement. So you got to take the bank balance and reduce it by the amount of outstanding checks. So 12 is C. 13, internal control does not consist of policies and procedures. Answer there is C, that guaranteeing. To know how good the internal control is not going to guarantee that the company is going to earn a profit. It will protect the assets. It will ensure employees comply with laws and regulations. We'll get accurate information, but it's not going to guarantee we're going to make a profit. 14, this is a quote here, to maintain public confidence and trust in financial reporting of companies. That was the purpose of the Sarbanes-Oxley Act that came in the wake of Enron. 15, a $1,200 petty cash fund has a petty cash on hand of $20, which means we got to replenish the fund for $180. The journal entry to replenish the fund would include a credit too. So you're going to have to debit various expenses for $177. You're going to have to debit cash short and over, and you're going to credit cash for $180. That would be the actual entry. So if you look for, that's the actual entry. Debit to expenses of $177, debit cashing over for $3, and a credit to cash $180. So your answer there is D, as in dog. 16, when a company uses the allowance method of accounting for uncollectible accounts, the entry to reinstate an account previously written off was, well, when we wrote off the account originally, we would have debited the allowance for doubtful accounts and would have credited the accounts receivable and the name of the company and the subsidiary ledger. So when you reinstate the account, you're going to actually debit accounts receivable and credit allowance. So the answer there is D. 17, the allowance for doubtful account has a credit balance of $1,300 at the end of the year before adjustment. Company prepares an analysis and estimates the amount that's going to prove to be uncollectible is $41,900. What is the amount of the adjusting entry that we make? Well, you got to bring the balance of allowance account up to $41,900, but you got to remember, look down below there at D. It's got to get up to $41,000, but you've already got a $1,300 credit balance. So the amount you got to increase the allowance is actually $40,600. So the answer there is D. Debit bad debts expense $40,600, credit allowance for doubtful accounts. And 18, when the allowance method is used to account for uncollectible accounts, bad debts expense is debited at the end of the accounting period when you adjust the financial statements. You actually recognize the expense of the account proven to be uncollectible by debiting bad debts expense and crediting the allowance. You actually do that before the individual accounts go bad. So it's at the end of the accounting period. So the answer there is D. 19, which method of estimating uncollectible accounts focuses on the income statement? Percentage of sales focuses on the income statement, and the aging of accounts receivable focuses on the balance sheet. So the answer there is C. And the last one, we've got a note that's dated March 1st for $40,000. It pays 6%. It's a 6% note, but they say we're preparing financial statements as of March 31st. So the interest is not going to be collected until the end of 4 months, but this note was outstanding from March 1st up until the end of the year, March 31st. So you got 1 month's worth of interest. So 40,000 times 6% times 1/12. You could have also put 30 over 360, gives you $200. So there's your entry: debit interest receivable, credit interest revenue. Now let's get to the problems. So what you had to do here, and I told you there were going to be journal entries. You can't do financial accounting without doing journal entries. So Purchase. So you had to take these transactions, and yet quite a few of you, I put the full amount. Some of you just put the debit or just put the credit. Full journal entry has both the debit and a credit. You don't have to put in any explanations. So these are the transactions that you should have had. Purchased $6,000 merchandise on account. That's a debit. We're using a perpetual system, so it's a debit to inventory, credit to accounts payable. Returned $1,500 merch of the stuff that was purchased previously because it was defective. Debit accounts payable, credit inventory. Some of you got confused between accounts payable and accounts receivable. Accounts receivable is when customers owe us money. Accounts payable is when we owe money to suppliers. On the 7th, you had two entries. You had to record cash sales of $9,750, so that's a debit to cash and a credit to sales. You also had to record the corresponding cost of goods sold, which was $4,000. So we debit cost of goods sold, we credit inventory. On the 10th, sold merchandise on account to a local breeder, $5,500 terms, net 30. There's no discount on this one. Some of you screwed up here. You assumed because there was a discount on one of these transactions, there was a discount on another. This one, we didn't give them a discount. So it's just the debit to accounts receivable and a credit to sales. And when they pay us later on, we're not going to recognize a discount. And the stuff cost us $200, so we debit cost of goods sold and we credit inventory. Paid for the purchase of August 1st, less to return. So we bought $6,000 on account. So this is $6,000. We returned $1,500, which means now we don't owe them $6,000, we owe them $4,500. And if we paid within 10 days, we're entitled to take a 2% discount. So 2%, not times 6,000, but 2%, 6,000 minus 1,500, which is 4,500. 2% of that is 90. So my transaction to record the payment is a debit to accounts payable, a credit to cash. And since we're using a perpetual inventory system, the amount of the discount is actually recognized as a reduction of the cost of the inventory. And the last one on the 20th, and a lot of you assumed here that we had a discount on this thing. It says receive payment on August 10th, but the sale on August 10th, there was no reference of an early payment discount. So we're going to get back the full $500. So a debit, cash, credit to accounts receivable. Next one here, a couple of ways you could have attacked this. And by the way, you got to show your computations. Going forward, you always have to show your calculation. You give me an answer next time and you don't show me your calculation, so I'm going to just give you 0 credit for this. You got to show the calculations. So here are the actual, this is what ends up in ending inventory, 39,830. And here's what ends up in cost of goods sold, 51,500. So remember, under the perpetual inventory system, every time you record a purchase or sale of inventory, you've got to adjust the inventory, you got to adjust the cost of goods sold. So here's was the stuff that we originally had, the original purchase. And then we sold, of those 600 units, we sold 200, which means we had 400 left. And then on the 11th, what happened on the 11th? On the 11th, we purchased another 350 units. So here is 350 units times 82. And on the 12th, we sold 275 units. But again, it's last in, first out. So you're actually going to sell those out of the stuff that was there originally, from the most recent purchase there. So those 275 units come out of this purchase of 82, which means you still got the stuff you had at the first purchase, but now you've only got 75 units at 82. And then on the 22nd, you purchased 175 units at 85. So there I added to the inventory 175 units at 84 rather. And then on the 23rd of November, you sold 155 units, but those 155 units, they got to come out of the most recent purchase. So that gives you this amount here. And now I notice I extended all my inventory here. So my ending inventory is made up of all these costs, 32, the 6150, 1680, which gives me 39,830. And if you take the total of the 16, the 22,550, and the $84 there, you get the 51,570. Okay. So that's how you come up with, got a little typo there. I say 22,660, that should be 22,550. So that's a little typo I made there. Ignore that. So here is the actual breakdown of the ending inventory and the cost of goods sold. Number three, this was a pretty simple one. Some of you got confused. And remember, this was the bank statement. This is a debit and credit memorandums appearing on the bank statement. Remember, to us, the bank owes us money. So anytime they put more money into our account, it's a credit memo. Anytime they take money out, it is a debit memo. So EFT payment, they would have taken money out of our accounts. That's a debit memorandum that would have reduced our account. Bank correction of an error due to posting another customer's check to our account. So they goofed. They took money out of our account that they should have taken out of somebody else's account. So when they put it back in, that's a credit memo because they're increasing the balance in my account, and that's going to increase my cash. Service charge. This is when the bank takes money out for service charge. So they take money out, they reduce my account, they debit it, that decreases the account. Note and interest collected for the company. So the bank collected money on my behalf. They put money in my account. Anytime they put money in my account, that's a credit memorandum that increases the balance. Bounce check. The bank, I deposited a check that bounced, so they take the money out of my account. So they debit my account, and that decreases the account. Bank correction of an error, a $250 deposit at 520. So the actual amount of the deposit was 250. They recorded it as 520. So they actually have to reduce my account by the difference between those two, which I think is 370. So they would reduce my account. They would debit my account, and that would decrease it. An EFT deposit is when money goes automatically into my account. Example, this might be those of you who are paid and get automatic deposit. So when they put money into my account, anytime they put money into my account from the bank's point of view, it's a credit. So that's a credit, and that increases the balance of my account. Again, so when it comes to interpreting the bank statement, when they take money out, they debit my account, such as the EFT payment, which decreases it. And when they put money in, they credit my account, and it increases it, such as the EFT deposit. So to get full credit on this, you had to get all these little boxes here correct. So, I was pretty generous in terms of my grading here, but to get a full 10 points, you had to get all those boxes correctly. Next one was very, very similar to stuff we had done in class and similar to homework. So what you had to do is you had to come up with the estimate of the uncollectible accounts, which was 30,110. So you had to multiply this balance here by the percentage that's going to prove uncollectible. So here's your balance in the allowance. But we told you that the balance in the first case had a balance of 9,700. So the amount of the adjusting entry would not be 30,110 since you already had $9,700 credit balance in there. You have to increase it by 20,410. And in the last one here, what if the balance had a debit balance? So if it had a debit balance, then what you had to do is you had to totally wipe out that debit balance. So it would have been 30,110, which is the balance you want to get it up to. Plus you got to wipe out that debit balance. So it's actually 39,810. Okay, and I think, let's see, 1, 2, 3, 4. Yep, that's it. Okay, so I hope you found that review useful. And again, I recommend as you watch this, hopefully you've got your exam out in front of you. So if you watch it the first time without your exam in front of you, go back and get the exam in front of you. All right, so I hope you found that useful, and we will see you this evening, or this afternoon rather. See you shortly. Bye-bye.